Let's jump right into this explainer and unpack the foundational mechanics of the mortgage finance industry. If you truly want to understand how capital flows into real estate, you've got to look through the lens of clear, structured standards. So today we're going to explore the absolute blueprint of this industry, specifically looking at how it's classified and measured under the Sustainable Industry Classification System, or SICS, where it goes by the code FMF. Here is our roadmap for today. We'll hit 1. Defining mortgage finance. 2. The SASB standards framework. 3. Transparent lending practices. 4. Preventing discriminatory lending. 5. Environmental risk to properties. And finally, 6. Measuring financial sustainability. All right, Section 1. Defining mortgage finance. So, under the Sustainable Industry Classification System, code FNMF specifically isolates entities within the broader financial sector. And what is their primary function? Well, they lend capital to both individual and commercial customers. The absolute defining characteristic here, the whole foundation of the thing, is that they use property as collateral to back those loans. That is the bedrock of mortgage finance. Now, if you read the actual industry description from the standards, it points out that this industry, quote, provides an essential public good by enabling consumers to purchase homes and contributing to the overall home ownership rate. I think that's incredibly powerful. You know, despite all the cold, complex financial mechanics we're going to look at today, at its very core, this industry is fundamentally about people. It's the essential mechanism that turns the very human dream of home ownership into a reality. But let's be real, the day-to-day operations in this sector go way beyond just handing out loans. We're looking at a comprehensive ecosystem. Sure, entities in this space are issuing residential and commercial mortgages, but they're also deeply involved in mortgage servicing, providing title insurance, executing closing services, and conducting property valuations. They even own and manage real estate-related investments like collateralized mortgage obligations. It's the whole shebang. Moving right along to Section 2, the SASB Standards Framework. Remember the global 2008 financial crisis? Yeah, following that, there was a massive industry-wide regulatory shift toward consumer protection, strict disclosure, and real accountability. And that is exactly where the SASB standards come in. They're now under the stewardship of the International Sustainability Standards Board, or ISSB, of the IFRS Foundation. Basically, these standards are meticulously designed to help companies disclose sustainability-related risks that could ultimately hit their cash flows or their cost of capital over time. I honestly like to think of these sustainability metrics like a structural inspection, but for a bank's portfolio. Think about it. Just as you absolutely wouldn't buy a house with a cracked foundation, investors shouldn't buy into a mortgage company without thoroughly inspecting its underlying risks. The SASB standards give us the exact tools and metrics we need to perform that inspection. Section 3. Transparent lending practices. You know, the way a mortgage entity actually incentivizes its employees is crucial to its overall stability. Bad incentive structures can completely unintentionally encourage loan originators to push really unsuitable lending products onto their clients just to hit arbitrary targets. We're talking about incredibly risky structures, like combined fixed and variable rate mortgages with super short reset periods, or loans packed with aggressive prepayment penalties. A lack of transparency hurts real people. It severely impairs a company's reputation, and it practically invites incredibly costly regulatory scrutiny and litigation. So, if we know for a fact that poor incentive structures and a lack of transparency lead to toxic portfolios, how exactly do we measure when a portfolio is actually in distress? Like, what are the specific red flags we should be looking for? Well, the standards track this distress with incredible precision. Reporting entities don't get to just hand-wave or give vague estimates. They are literally required to disclose the exact number and total loan value of residential mortgage modifications, foreclosures, and short sales, or deeds in lieu of foreclosure. By quantifying these specific hard outcomes, stakeholders can see exactly how many loans are changing from their original terms or just failing completely. Section 4. Preventing discriminatory lending. Look, mortgage origination is a deeply, deeply complex process. It relies on aggregating massive amounts of data to determine loan sizes, interest rates, and upfront points. But this level of complexity can sometimes lead to intentional or even completely unintentional discriminatory lending practices. So how is fair access to this essential public good actually monitored in the real world? Regulators demand absolute transparency across the board. Entities must disclose the number, total value, and, critically, the weighted average loan-to-value ratio of mortgages issued to minority borrowers compared to all other borrowers. And that loan-to-value, or LTV ratio, is a hugely powerful indicator. A higher LTV means the borrower has less equity in the home and therefore carries a much higher risk. By strictly tracking this, right alongside internal policies like staff training, institutions can actually prove that access to home ownership is being provided fairly and totally without bias. Section 5. Environmental risk to properties. Now we have to look outside the bank and at the physical properties themselves. This specific metric is absolutely critical for the industry. Entities must disclose the number and value of mortgage loans in their portfolio that are underwritten on properties sitting in 100-year flood zones. And just as a quick refresher, a 100-year flood zone means an area subject to a 1% or greater chance of flooding in any given year. Obviously, if your collateral is literally underwater, the financial risk to the lender is immense. And the standards go way beyond just floods. They require disclosure of total expected loss and loss given default, attributable to all weather-related natural catastrophes. We're talking meteorological events like severe hurricanes, hydrological events like massive floods, and climatological events like intense, sprawling wildfires. These aren't just interesting weather reports on the evening news. They represent massive financial destruction. They directly cause mispayments, force loan defaults, and severely decrease the value of the underlying collateral. Mortgage companies have to explicitly explain how they're incorporating these very real physical threats into their underwriting models. Section 6. Measuring financial sustainability. By treating a mortgage portfolio to a really rigorous structural inspection, looking hard at lending practices, fair access, and environmental threats, we get a true, undeniable picture of an entity's health. So the ultimate question I want to leave you with is this. As extreme weather events accelerate and fair lending protections tighten, which institutions will adapt to protect our essential public goods, and which ones will be left holding a portfolio built on a cracked foundation? Thanks for joining me on this explainer, and definitely keep questioning the structures behind the numbers.